in Times Square. Allie, the economic cycle. Joining me now to discuss is Larry Tentarelli, Chief Technical Strategist at the Blue Chip Daily Report, alongside Yahoo Finance senior reporters Ines, Ferre, and Allie, Canal. So, Larry, I want to start with you talking a little bit about that jobs report that Allie was just discussing, and also that reaction we saw from the market on Friday. We initially saw that rally, traders getting very excited about the certainty, really, of Fed cuts that we're going to get starting in just a couple of weeks. Some of the enthusiasm faded. I'm just curious how you thought about that action we saw Friday and carrying into what's kind of a mixed open, as Allie was just mentioning here, to start the week.
Good morning, Myles. In the near term, we should expect higher volatility around any news events. But I think overall it's bullish, because what happened on Friday is with that very weak jobs report, it's really cemented a Fed rate cut coming next week. And although September is historically very volatile, I think that these Fed rate cut expectations are probably going to put a floor in volatility. And we're seeing rotation into some of these rate cut trades, homebuilders, gold miners, small caps. So net, I think the weak jobs report is going to be a positive.
Allie, you are our inflation expert here, our inflation specialist here at Yahoo Finance. Can we talk a little bit about the expectations for that number on Thursday? And I think this dynamic around everything seemed okay on the inflation front as we got through the first, let's call it the spring, kind of around Liberation Day. And looking at the forecast for Thursday, all of a sudden it feels like just as Jay Powell comes out at Jackson Hole and says the labor market is my number one problem, he now has a more material problem on the inflation side of the mandate.
Right, it's the tension of the Fed's dual mandate that a lot of strategists have been discussing. And if we look at expectations, we are expected to be firmer across the board, with core in particular. And what we saw earlier this year was that decelerating services inflation was offsetting some of the price increases that we were seeing on the goods side. And remember, when Trump put in those tariffs, that was flowing through into goods. Now, we didn't see that as aggressive as perhaps Wall Street strategists had initially forecasted. However, we did see a little bit of firmer prices. But again, because services were coming down, that really didn't show up too badly in consumer prices. However, last month, we did see that reversal where services inflation was a bit more sticky. And that was a top concern from economists, because if we move through the rest of this year and we see services come in hotter, that's going to be a problem for the Fed, because that suggests that there is possibly something a little bit more sinister going on underneath the surface of the economy, because that is not directly tied to tariffs. You would more so see that on the good side. So that's something that traders will be watching very closely. How sticky is core inflation? Are we seeing that reacceleration on the services side? So that's everything that investors are keeping an eye out, because there is that tension of the Fed's dual mandate as they really decide on how quickly they're going to cut rates. I do think the expectation for a cut in a couple of weeks is pretty much done at this point, a done deal, I should say. But later this year, that is a big question. How much more aggressive will the Fed be, and how many more cuts will we see to close out 2025?
Yeah, the Fed's in a blackout this week, so we won't hear from any Fed officials. But Friday we kind of left it at, will it be 50 or 25 come on the 17th? So we'll see how much we can kill time amongst one another in the next 10 days on that one. Ines, related to that inflation trade, I want to talk a little bit about what we've seen in gold. As we mentioned, gold at a record high this morning. We're closing in on $3,700 an ounce. I know this is a space that you follow closely. You've talked to a lot of folks within that space. And, I think that gold has now kind of gotten into this place where we discussed, Bitcoin, and Bitcoin is a very interesting part, of that haven trade, where it fits into portfolios. But it really overshadowed gold as the old-fashioned portfolio hedge, and it is certainly in vogue. And I'm just curious, given the folks you've talked to and the way you're looking at the space, how you see the setup for that trade, one that's certainly worked tremendously well if you were long gold, certainly in 2025.
Yeah, most certainly. And look, the soft labor data that came out just supported the prices really because the market is expecting a Fed rate cut. But nonetheless, you are seeing that central banks have been buying up gold. People's Bank of China in August bought gold again. So for the 10th consecutive month, you've had the People's Bank of China buying gold. Central banks are expected to continue to buy gold. And that's been sort of a structural change. So unless you see the dollar rising substantially, Wall Street is still expecting that you're going to have easing monetary policy, and you have this structural change with central banks that are continuing to buy gold. And then you even have some calls. Goldman Sachs has a bullish call for 2026, for the end of 2026. In an upward risk scenario, you could see gold going to $5,000 an ounce because they're saying you may have even private investors sort of shifting away from U.S. Treasuries into gold as well. So Wall Street remains bullish into 2026 for gold prices.
Larry, I want to get your thoughts here on gold, not just the rally we've seen in the commodity itself, but I know there's a couple names, or at least one name that you're looking at as a way to play that trade inside the stock market.
Sure. Gold is very strong, breaking out to new all-time highs. It just consolidated for about 4 months. And I agree with the bullish case of fiscal deficit problems. We've got a weaker dollar. And the gold miners in particular have been very strong and have started to surpass gold in year-to-date performance. So Newmont Mining is a standout in that sector. Newmont Mining is the largest market cap gold miner in the markets. They're also the only gold miner in the S&P 500. And what we saw to start the year was gold really outperformed the gold miners. But then a few months ago, there was a rotation into the gold miners as a catch-up trade. And gold miners are one of my favorite ideas here because they really work into the Fed easing cycle, and they're not really tied to the U.S. consumer. So if we get weak jobs data for a few reports in a row, then some of the consumer stocks like small caps, banks, they could see some volatility. But one of the benefits of gold and gold miners is they're really not tied to the consumer at all.
And Larry, I'm curious just on the price of gold itself, the commodity itself. When you look at that kind of a chart, the move we've seen, the breakout we've seen from really what to my eye looks like a multi-year base, how you think about that from a technical standpoint? Because again, I think people see, asset X is up 40% this year. They're like, oh, how much further could it go? What does the chart look like to you at this point in time?
The first target on the chart right now is 4,000, and that's based on the 4-month consolidation that we recently broke out of. So the trajectory for gold is very high. And if you look back over the past 20 or 30 years, when gold consolidates for a long period of time, when it breaks out, it generally has a very sharp, prolonged breakout. So although a lot of people will look at new highs and the question is how far can they go, a lot of institutional investors will look at new highs as a bullish signal and continue to buy. And that's my view. So I would look for 4,000 going into the middle of 2026.
All right, now, Allie, I want to talk a little bit about something else that's near record highs, which is the stock market. I mentioned that at the top. And I know that in the wake of what we saw on Friday, again, that kind of mixed reaction, the both ways, we're not totally sure what to make of it. We got out of the jobs report. I think coming into this Monday, and we always get the strategy notes out from our friends on Wall Street on Sunday evenings, where their heads are at around this idea of we know what's going to happen next with the Fed, and we know what, in theory, that should mean for the stock market, but it doesn't seem like full commitment from the strategist community right now.
Right. Wall Street can't decide if it's bullish or maybe a little bit more cautious. And we have a variety of Wall Street notes out there that say, look, Fed rate cuts are going to be a good thing for stocks. Goldman Sachs strategist David Kostin, he is very bullish on the long-term outlook. He thinks that rate cuts will mean the rally will extend into small caps, which has really been an undervalued part of this market. But then you have others that aren't quite sure. Ed Yardeni, he argued that rate cuts are not needed in this environment where you have productivity gains from GDP really solid at this point. He actually warned that a rate cut right now could lead to a market melt-up, especially at a time where we could be cutting into an environment where inflation remains sticky. So there is a bit of a trepidation among strategists when it comes to what ultimately rate cuts could mean for the longer-term outlook of the stock market. You were just saying that stocks are at record highs. A big reason for that has been the AI trade, but then you have this tension of how concentrated we are in the AI trade. Torsten Slok from Apollo Global, he called that out, saying the market has never been as concentrated as it is right now, and that risks fueling a potential tech bubble. You have Data Track Research saying that the AI trade at large looks a bit wobbly. We still don't have record highs for NVIDIA and Microsoft. We haven't seen those in weeks. And then you see some other non-AI related names like Apple catching a bit of a bid. And when you have a stock market that's really been propped up by these AI names, what does that mean throughout the course of 2025, how we end the year? So it seems like rate cuts are not a done factor when it comes to fueling this stock market higher here. So there's just a lot of overarching risks that strategists are calling out. And I think you can see that in the trading that we saw on Friday when we saw that initial spike and then a bit of a pullback where investors were trying to assess what this means.
That was a good inadvertent sentiment check there, Allie. We've gone weeks without record highs. How could we? How could we go weeks without record high in NVIDIA? Larry, before we get out of here, I want to get your thoughts on another way to talk about rate cuts and a move that I called a stealth move in housing stocks. I'm curious how you think about it because we've seen quite a move off those April lows, particularly in home builders. And the housing market has not had a good couple of years. I think a lot of optimism that maybe these cuts gets it off the mat. Curious what you're seeing there in the charts.
Very strong in the home builders. So what we've seen since July 1st, there's been a really strong rotation into rate cut beneficiaries, home builders, small caps, even biotech and solar, regional banks, things that benefit from rate cuts. With the home builders, what you're seeing is a long-term trend reversal. You've got a weekly uptrend on the charts. They recently reclaimed the 40-week moving average. You've got stocks like DR, Horton, Toll Brothers that are breaking out. And the market has moved into these home builders really over the past 6 weeks or so, 6 to 8 weeks, based on these Fed rate cut expectations. And historically, once the Fed starts to cut rates, and I know they've cut rates before last year in the cycle, but once they start to cut rates, they generally don't just make one cut. There should be a series of cuts. And the home builders have been leading over the past 8 weeks. And as long as we get the expected rate cuts, I would expect these home builders to continue to lead. Very strong charts.
All right, Larry, Allie, and Ines, stick with me. Coming up on the other side of this break on opening bid, we'll have our stock of the day.